Good morning. Oh my goodness. The snow yesterday was beautiful. As long as you were, nestled at home with blanket on and your jammies. I know my whole team was working in their jammies. Did you get dressed yesterday?
I did because I took the kids out to go sledding.
Oh, that's right. I did see that on Facebook.
Yeah,
How was that?
It was fun. We just stayed in our backyard and I just tugged them around in my backyard in the sled. So much work. They're getting so big. And I only have 2 sleds.
Yeah.
So I've got one that was for an infant that Bodie wants to be in.
Oh
And
gosh.
so I was tugging him around in the yard in the
tiny sled.
In the tiny sled.
Right.
I was like, I can't do this. This is really hard. I'm exhausted.
You got to work out.
I got to work out in yesterday.
Yes, you did.
I got a little hill in my backyard that goes right down by the fence. So they were kind of sledding
Yeah.
down the little hill. And I was like, it's cold out here. I don't know that I want to be outside doing this.
I'm pretty sure you could have done that in your pajamas though.
Yeah.
You didn't leave your yard.
No, didn't leave my yard. I did have sweats on all day though.
Yeah, I loved yesterday. It was so good. I did go out driving and I-25 was like empty. Like you could literally have like sped 90 miles an hour, done donuts, kept going.
Nice.
And there was nobody out there.
Nice.
So it was a lot of fun. My team, I know, is in the process. Our lease is up July 31st. So if you know of any off-market deals, we're trying to decide if we buy or rent again. There's 14 of us. So that's something to throw out there to a whole group of real estate agents. I need a place to go. So here's our quote for the day as we get started. If you were at the DMAR Economic Summit, wow, what a day. It was a packed room. I know we had so many great speakers, great content. Economic out, maybe. We're going to touch on some similar things, what happened since then. Especially if you listen to Elliot and Patty and talking about what's happening here in Colorado, what's happening in the economy. We're going to talk about that on the back half. We definitely got some good news yesterday. I did a quick TikTok on that. I did TikTok.
You did TikTok? All right. I haven't ventured into the TikToks yet.
I'm too old to do TikToks. Too old. But we did that. We talked about what was happening, the news that came out. So here's the quote that is really in alignment with the conversation that we were having on Friday at the DMAR Economic Summit. So instead of worrying about what you cannot control, shift your energy to what you can create. I love that word, right? Create. And right now, this year is going to be such a mindset shift as we find normalcy again, whatever normal looks like today. It really is going to be about not just doing business the way you used to do it in a market that's normalizing, kind of like what we're going back to. But if you did business like you did it in 2019, it's not going to work.
Right.
It's different. The technology is different. The artificial intelligence is coming out. The mindset of the buyers walking into a recession, how you're communicating with them, how you're pulling them in and kind of surrounding them as a partner. All of those things are so different than they were in 2019. So as I think about this, I want to make sure I'm going to do the quick plug for the next big thing right now instead of in the slide deck, because I was thinking about the speakers that we have and I could not have planned it any better. It was coming
nice,
right?
I love that.
And because it's not all about the tactics, it's about the mindset shifts. It's about the creativity. It's about having success in a turbulent, changing market. It's about AI. We're talking about what's happening where it's writing your blogs for you and doing your marketing and doing your outreach to your database. I mean, that's crazy. As a real estate agent, you need to know what's happening. You need to be shifting your thinking to storytelling and branding and creativity and customer service. What's your client journey? I was talking to a good friend, Jeremy Kane, yesterday, and we were talking about defining the client journey so succinctly that others, not only clients, but other agents can follow it as he continues to build his team. But we have a client journey in the Ruth team, and I know you have an experience set of standards that you have for your agents.
Of course.
Right? So it's how are you thinking about those things, which is what we're talking about on February 2nd.
That's so great.
It is so cool.
Perfect timing.
All right. So as that goes, we're seeing an uptick in activity.
Yes.
Right?
Yes. I'm thrilled to see that start to happen. It actually happened a little bit earlier than what I thought it was going to, which is encouraging because the last 2 weeks of December were absolutely quiet. And it was unnerving how quiet it was
didn't
with the
like
holidays falling over those weekends and creating long weekends. The market activity just completely died off during the last part of December. It started out great.
Right.
And then there was just nothing happening for the
Mhm.
last 2 weeks of December. So I was curious to see if that was going to become our new normal or if we were going to see the uptick after the first of the year. And so we did see a nice little uptick of activity, and it continues to roll forward. So I'm thrilled to see some of this happening.
Well, certainly we have no play in the Super Bowl.
No play in the Super
So
Bowl.
didn't need to wait for that.
No.
It is interesting because we were thinking that was going to happen in the spring, and it still is going to pick up in the spring. This
Mhm.
isn't the go time. This is the rev of the
This
engine.
is the
right?
ramp up. This is the ramp up for those
Yes.
people that are just getting out there. And what I'm noticing in the numbers is there are a lot of people looking, but they're not necessarily jumping quite yet.
Yeah. And we're having a ton of conversations about first-time home buyer specifically.
Mhm.
Agents, you guys are talking to more first-time home buyers than you have maybe in years because they're coming back out of the woodwork.
Mhm.
So as you're talking to first-time home buyers, what programs are available? How can I access? How can I help affordability? Those are the questions and conversations we're having right now. And I love it, but it
Mhm.
is definitely, it's a mindset shift from what we just experienced the last couple of years.
Yep.
Yes. You know, and I think about this too. You and I we're gonna be able to talk about this when we look back at this time right now, this January 15th through February 15th. Will that be the bottom? Will we be able, because you can't quite tell when you're here,
Mhm.
but will we look back and go, that was the best deal you could get?
Yes.
And then it was gone.
I really do think it will be.
Yes.
I really do think that the buyers that were in the market from November, December, January, and the very beginning of February, I think that they're the ones that are going to come out on top. And they're walking into positive equity, and they've got less market competition that's happening right now. They do have fewer choices available for homes for sale, but the deals that they're getting right now are not going to be around, I think, come this
I
spring.
don't think so either.
And so I think it's really important that buyers are out there and taking advantage of the market now before the market really picks up after Super Bowl weekend. And so we're ramping up into that competitive phase. And I'm hearing more and more agents talking about, I had multiple offers on my deal again.
Yes, I am
And
too.
so I'm starting to see that in some of the numbers, and January is going to be really telling if we see that market pick up or not. I actually had one agent come up and tell me, they were like, I had multiple offers, but they were all under asking price. And I was like, that's really interesting.
It is. Well, we had one of the agents were talking about that last week even. So it wasn't the first time, it wasn't the last time we're hearing that.
Mhm.
It really is important to price that home right and
It
stage
is.
it well and take that
Yes.
little extra effort.
Yep.
So important right now.
Yeah. Pre-inspections,
Yes.
repairing the home,
Yes.
cleaning the carpets, staging the properties, having really great photos of those properties, offering a home warranty if it's an older house. These are all things that are going to help you win the deal.
Cleaning the carpet. You gotta do
Cleaning
that
the
too?
carpets. I know I need to clean my carpets really bad.
That's what we just did ours. We
Uh,
had the team come over and I was like, okay, I can't even look at this anymore.
I know it's making me crazy. My
Yeah.
mom has a rug doctor, so I borrowed the rug doctor to clean up some dog spots in my
Yeah.
house, and I was like, "There's no way I'm gonna make it through this whole house on my own. There's no way." I was like, "I'll get some of the spots up, but I
Right.
can't do this whole house on my own."
Well, let's see what's going on in the Denver
Let's
real
go ahead and
estate
hop onto
market.
it.
Yeah, I'd love to.
Let's see this one. So let's make this a little bit bigger and hop into the slideshow. Oh. And so this
Okay.
covers the week of January 11th through the 17th of 2023. And so again, my report's a little bit different than the DMAR report that gets put out, which is a great report, which I would encourage that you look at, but I only cover the 7 Metro Denver counties. So I cover Adams, Arapahoe, Broomfield, Denver, Douglas, and Elbert counties, whereas the DMAR report also incorporates El Paso County. It also incorporates Boulder County, and then also one up in the mountains, I think it's Gilpin County. And so there's a little bit different. I think there's one more that I'm missing in there, but they cover 11 Metro counties. I only cover the Denver metro area,
Right.
because I think that El Paso and Boulder counties are very different, different markets. And so I separate those out and I don't look at those. when I look at
Especially
this
Boulder,
report.
because it's not all in RE Colorado.
Right.
Yeah.
Yeah. And so I want to make sure that I'm looking at a complete data set. And again, here's our strategy sheet going into 2023. And we're looking at this January, February timeframe right now, where the red cells start to pop in and we start to see the market warm up as we get into some of these areas. But we're targeting a 56.5% odds of selling decline as we get into January and February. That's a target listing or a closing month of March based off of average days on market, median days from contract to closing. And so we're looking at warming up as we get into January and February. March and April really are the best timeframes in which to be a seller in. Again, looking back here at November, if you were putting properties under contract in November, December, October, you really had some good negotiating power in there. But I think that we're going to see that return to pre-COVID 2013 through 2019 for our market trends. Looking at our strategy sheet for 2023, we don't quite have enough data in there yet to start seeing those cells warming up or cooling down. Give it a couple more weeks and we'll start to see that warming trend really pop in, but you could see that some of the cells across the bottom turned more red as our market started to pick back up again. Big story here is our average daily active count. As we head into the early spring months, getting into February and March, we start to see our inventory continue to decline. We start our inventory decline back in September, and then it continues to decline until about the middle of March, beginning of April, where we start to see more of those listings pick up. But our average daily active count, again, fell by 2.3%. But what the media is going to glob onto is that our average daily active count is up 234% from where we were 1 year ago. And we can't compare this year to last year because our market conditions are greatly different with higher interest rate environment. And so that's what the media is going to talk about. When I average out 2013 through 2019, we are dead on accurate with where we should be for our active inventory, and that creates predictability in our market. So I'm able to go through and actually create projections based off of what's going to happen because we have some normal seasonal cycles that are in there where there's a nice normal seasonal cadence. But this report we started back in the pandemic, so it only goes back to 2020 when I measure it on a weekly basis. But you'll start to see that in the monthly reports where we have this more return to a normal seasonal market.
Question on the inventory. So nationwide, we're talking about the fact that we're getting seriously close to dipping below 1 million homes for sale again. Now here to say that this is normal, that if you average 2000, what did you say, 12 or 14?
13 through 19.
So then this is normal. So are we expecting that we're going to go below what normal inventory is, or do you really think that we're
slightly below? We're slightly, ever so slightly below where we've been averaging from 2013 through 2019. I just went through and worked up all of those numbers yesterday to get my projections ready, which will come out next month. And I'm going to try and get them out early in the beginning of the month so that you guys have access to all of that data for what I'm projecting. The one thing that I'm struggling with is appreciation. Appreciation is projected to remain flat, if not slightly up. And so I look at that on a monthly basis when prices are rising and falling. And I don't think that we're going to see the big price gains that we saw a year ago. And again, the media is going to glob onto the fact that we were at an $820,000 average sales price in April of last year. Now we're sitting around a $710,000 average sales price. And so again, they're going to be signaling market crash, but again, there's been a correction in our marketplace due to affordability. Year over year, I think that we're going to see negative appreciation going from February until about June. If interest rates drop in the second half of the year, we could expect another run on the market where people are trying to get in. So be on the lookout for that. But I think that our market is really dependent on if and when interest rates drop to drive what's going to be happening in our marketplace.
And I'll show you a little bit of the statistics why. So Barry Habib, I know I've had a couple of agents asking me about this saying, well, we've heard May 10th is the date. And I know that that's circulating.
I've heard that come up a lot too.
Yes. He's done a number of presentations and he shows us why. So I actually grabbed that from him to show you kind of the why behind the May 10th number. But if that happens, that really is kind of a good date to get a good chunk of real estate transactions in that can keep our home prices up. Because if it gets delayed for some reason, that's where we're going to see that flat and really low appreciation.
Right. Exactly. Month supply of inventory dropped back down to 1.2 months worth of inventory. And so again, we're getting really low in terms of our supply of inventory. Basically what that number means is that at the current rate of sales, based on what the active listing count is, that's how long it would take in months to sell off the existing inventory. We're still well below that 6-month supply of inventory. We're still well below the 3.5 months worth of inventory. That's the average for Metro Denver when we look back over the last 20 or so years. And so we're still very shallow in inventory. I'm not expecting there to be huge gains in inventory this year because of interest rate gridlock, where a lot of people went through over the last 2 or 3 years and they refinanced their homes into 2 or 3% interest rates. They don't want to move into a smaller house for more money. And so And so what's going to happen is people are going to stay and age in place and stay in the home that they have. So I'm not expecting there to be huge gains in the amount of inventory that we have. I think that we'll probably peak out in about, usually we peak out in inventory around August, where we have about 5,000 to 6,000 active listings for sale. I think it's going to be a stretch to get there because of that interest rate gridlock.
I do too. And I keep going back to that Bank of America survey where they showed that how many owners are in the Gen Z and the baby boomers, right? How many homeowners are of that age group, and then how many of them, and it was like 70% and 70% of them want to hold on to the home that they're currently in.
Yes.
That's a massive shift for you as a business model too, right?
Yes.
So it's not just what is this going to do to the data and the numbers, but if you were counting on your database to turn over every X number of years to give you the client transactions.
People are staying in their homes a lot longer. Now the average tenure in a home went from 7 years to 10 years.
Right. And the expectation of 10 years, even longer than that from that NAR study.
Yeah.
So you got to get a little creative on how you find your clients, or the conversations need to shift.
Definitely. But we did see a pickup in pending transactions. Again, week over week, we went up by 18.7%. So the buyers are getting out there and they're looking at properties again. The odds of selling is where I take into account all of the available listings for sale versus those that go under contract and or close in the same month. And I project it forward for a 4-week period of time. It popped up by another 3.8%. So now we're at 51.9%, which is about where we should be for the month of January. So we're getting back into that normal seasonal cycle. I think a healthy number for this as we get into April and May is probably around 60 to 65% odds of selling. And so again, we're looking at that number rising as we get into our spring months. Then we'll start to see that number really pick up as we get closer to Super Bowl weekend. We're still nowhere close to a market imbalance. We have 20.6% of a market imbalance. For a market imbalance, we need to have about 21,000 active listings available for sale. So again, I've heard a lot more people that have started subscribing to my foreclosure, short sale, HUD home list. I'm not seeing a lot of those make their way to market. So if you're trying to find one of these foreclosures or short sales, keep in mind that out of the nearly 3,000 transactions that we closed in the month of December, there were about 3 distressed transactions.
Right.
And so at that point, are they really a deal? Because they're drawing out all of the investors who want to get those, creating multiple offers, driving it up over asking price. And so we're not seeing those as deals in the marketplace right now.
What we might see though are the HUD homes, right? So if you had FHA buyers that got into a home, didn't put any money down, maybe they used down payment assistance.
Yep.
We might see some of those. So I know that HUD just put out an announcement about their $100 down program.
Oh, wow.
So you can actually get an FHA distressed home with $100 instead of the 3.5%.
Okay.
So I would look if there's any distressed homes at all. And the qualifications to get into a mortgage these days is so high. So it's still going to be light, but if there are any distressed homes, there'll probably be HUD, and then you probably can take advantage of some of the programs that they have.
That's great. Looking at showings per property per week, we popped up 17.2% in terms of shows per property per week. So we were looking at about 3 shows per property per week this week. So that's encouraging to see that there are more buyers that are getting out there and looking at these homes. But what's interesting is that they're looking at more homes before going under contract. And based off of data from last week, it was about 16 showings to go under contract. And so they're looking at about 3 or 4 more homes before choosing to make an offer on a property. And so this could be a signal for you if you need to make a price reduction, you're not quite sure when. Again, don't reduce your price after 2 to 3 weeks. Wait until you've had the number of showings to come through, shows per property per week, the number of shows to go under contract, and median days on market before you start making price reductions. But we're looking at about 16 showings to go under contract right now. We ended up seeing that median days on market fell by a good solid chunk. It ended up falling down to 36. So it fell by, what was that, 7 days? Just this last week. And so there's some of that aging inventory that was put on the market back before the holidays that have been sitting on the market that's now being absorbed into the marketplace right now. But it was about 36 median days on market for those homes. We saw price reductions drop below half for the first time in about 6 weeks. And so it was 44.1% of everything that went under contract last week made no price reduction, whereas 54.6% had no change whatsoever. So again, we expect that number to continue to drop as we get into our winter months. Normally for January, we end up seeing this number around 36% of homes make price reductions. So price reductions are still higher this year than what we've seen in years past as we start to make adjustments for affordability. The average price reduction was about 6.6%, so that's come way down. We ended up seeing that it was up a little bit last week, but it's about $46,500 off of the original price right now for a good price reduction.
And I really do think you get rewarded by pricing the home correctly, or maybe even a
The
little
first
lower.
time.
Yes.
Price
Sure.
it right the first time. I have a
Yes.
ton of questions about, should I
Yes.
price high knowing that I'm going to make price reductions? And my answer to that is no, price in the market for the market conditions. If you
Yes.
go under contract, if you price it right the first time, it sells faster and for more money. Once people start to make price reductions, they smell blood in the water and they start to offer less than asking price because they think that it's a sign of desperation. So if you price it right the first time and show the buyer pool that you're serious about selling that home, you're more likely to go under contract more quickly at that particular price range.
I was talking to Tina Maldonado, and she had a listing, she might even be listening, that she priced aggressively. And we were talking about how does she reach out to those who were still doing showings because they already had 3 offers this past weekend. So I think taking those price reductions that you always talk about, I mean, it's like timely information, the Thursday right before the weekend, and taking those price reductions into account on the listing price.
Yes.
Right. And then let the market drive it back up again if appropriate.
Yes, absolutely. And I have heard that in several cases where like I made a price reduction and suddenly it drew out multiple offers.
Yes.
And so we do see that happening oftentimes. For the under $500,000 segment, we're now down to 1 month worth of inventory. So we're getting dangerously close to that below 1 month worth of inventory where we start to see multiple offers getting drawn out again. And so our average daily active count came down by 3.2%. We only had about 1,200 homes available for sale, but our pending transaction count went up by 1.4% with 291 units going under contract last week. The odds of selling started to pop back up again. We're now sitting at about a 59.9% odds of selling. This number will continue to grow as we get deeper into the spring months as we start to warm up outside. And so expect this market to become much more competitive. In this market, we only have 16.2% of the inventory required to offset demand. So we're dangerously shallow in terms of inventory. And again, a lot of people are choosing to stay in their homes, and we have a lot of entry-level buyers that are coming into the marketplace now, keeping these numbers very low. Shows per property per week, we ended up seeing that it popped up to 4 shows per property per week with just under 5,000 total showings that were set last week in this particular price range. So if you didn't get 4 showings on your listing, that could be sign number 1 that you're not in your target price range. But again, people are looking at more homes before going under contract. The buyers are out there, but they're being more discerning about what they choose to put under contract. They want to negotiate a deal, but it's 17 showings to go under contract right now. So again, if you're getting 4 shows per property per week and it's about 17 showings to go under contract, we're looking at about 4 weeks on the market right now. And that's showing up in our median days on market, where it dropped from 35 median days on market down to 27. So again, some of that new inventory that's popping up is getting absorbed very quickly. And some of that existing inventory is still keeping that number a little bit higher. I think a good number for this particular price range as we get into our spring months is probably going to pop down to about 2 weeks as we start to head into March. Looking at price reductions, only 39.2% of their homes reduced their price, and the average price reduction was about 6.7% off of the original price, or about $30,000 off of that original price. 500 to $1 million, this is our largest price segment, and again, this is where we're looking for the majority of our activity as we get into our spring months, but we've dropped down to 1.3 months worth of inventory, and it just dropped from Christmas week from 4.2 months worth of inventory down to 1.3 months worth of inventory, and this number is going to continue to drop. I think that we'll probably get below 1 month worth of inventory as we hit March and April, where we're down to like 0.8 or 0.9 months worth of inventory. But our average daily active count came down by 2.2%, and our pendings went up by about 27%. So we ended up seeing a nice little pop of activity where some of that inventory was starting to be absorbed from earlier this year. The odds of selling popped up to 50.4%. I'd like to see that number hit around 60 to 62% as we get into our spring months for the odds of selling to get back into that normal seasonal cycle from 2013 through 2019. That number should hit about 61%. In this market, we have 21% of the inventory required to offset demand, so no sign of market correction there. Shows per property per week popped up to about 2.6 shows per property per week. We were looking at about 14 showings to go under contract, so they're not looking at as many homes in this particular price range, which is surprising because this is really where the bulk of our transactions are, and they're the most interest rate sensitive. So when interest rates drop in this market from 500 to $1 million, we start to see more market activity as buyers get more serious. but we're looking at about 41 median days on market. So some of that aging inventory is starting to be purchased out of our marketplace right now. We saw about 47% of them reduce their price. 51% made no price reduction. So it's nice to see those price reductions come back under 50%. That ended up shifting down week over week by about 6.7% fewer price reductions as we got into this market. The average price reduction was also lower at about 6.5% or about $48,000 off of their original price. Between 1 to 1.5 million, this is only 7.6% of our overall inventory. Really perfect timing for this market is about March. Where we start to see the odds of selling really pick up, close to list price ratios really pick up, and days on market start to shrink. Looking at where we were for this week in terms of our month supply of inventory, it dropped down to 1.5 months worth of inventory from 3 months worth of inventory just this last week. So this market saw a lot more market activity. Our pending transactions went up week over week by 104.2%. So we saw these buyers return to market where they had been in a little bit more of a slumber during that first week right after the new year. Now they're really starting to get back out there and get things under contract. The odds of selling increased this week to about 44.6%. I'd love to see that number around 55% as we head into the spring months for a really good predictable odds of selling. In this market, we only have 16.7% of balance. And so this market is even tighter now too. But again, once you go over $1 million, these are less dependent on what happens with financing and interest rates, with over 40% of these buyers being cash transactions right now. Shows per property per week ended up jumping by about 31.2%. So we saw about 2.6 shows per property per week. So if you didn't get your 2.6 shows per property per week, you might not be in your target price range. And the number of showings to go under contract came down to 17. And so over Christmas week and New Year's, it popped up to 25.4. Now we're down to about 17 showings to go under contract. So again, great information for those of you needing to make price reductions. Wait until you've had your 17 showings. Median days on market ended up popping up. So there was some of that aging inventory that had been listed right before the holidays that are now going under contract, but it was about 45 median days on market right now. 44.7% of everything that went under contract last week made price reductions, and the average price reduction was about 6.3% or about $81,000 off of their original asking price. Last price range we'll look at is this $1.5 to $2 million price point. Again, your target time frame for listing in this market, February, March, beginning of April, really are your best time frames in which to list. Looking at where we came in for month supply of inventory, it actually popped back up this week. Our average daily active count came up by 4.8%, which is a little bit atypical where we start to see inventory rising this early. There were fewer units that went under contract this last week, with only 9 going under contract, which is why our month supply of inventory popped up to 3.3 months worth of inventory. But overall, historically speaking, that's not a bad number for this particular price range. If you want to compare this back to where we were in like October of 2007, we had over 12 and a half years worth of inventory. So looking at having only 3.3 months worth of inventory, I think that's a really healthy number. The odds of selling decreased this last week because there were fewer units that went under contract, but it was about a 28.8% odds of selling. Usually at this time of year, I start to see this number ramping up, but this last week we had kind of a lull. And so it was interesting to see that. We're sitting at about 27.9% of balance, so no sign of a market correction there. We're looking at about 1.3 shows per property per week in this particular price range, which was down 22.7%. And so a lot of people ended up staying home and not looking at properties this last week. Shows to contract was 19. So again, buyers are out there, but they're looking at more homes before putting units under contract. So about 19 showings to go under contract, and median days on market came in at about 66. 44.4% of them reduced their price, with 55.6% making no price reductions whatsoever. And the average price reduction was still large at about 11.2% or about $252,000 off of their original asking price.
That's a lot.
That is a lot.
So it's like, it's interesting to me that it's still that high, or maybe it's those properties that have not sold that you have to take action and you have to go deep just to get it to move.
Yep. So we've got some questions here. We've got a buyer under contract against 7 offers after about 40 showings, not hugely over ask, but a bit. And speaking of the deal buyers can get, the final price got an appraisal waiver. That's fantastic. Can you clarify the May 10th date?
So we're going to be talking about that during the second half and exactly why May 10th is going to be a really good time for the buyers in this market.
Doesn't lower inventory mean higher appreciation? We are seeing slight bidding wars on some homes now. You don't think that we'll still have positive appreciation? I don't think so, just because with the extreme year that we had in 2022.
As a comparison.
And that's due to interest rates. And so we're seeing multiple offers, but they're not going 8 to 10% over asking price like what we saw last year at this time. They're going for more like 2 or 3% over asking price, because people don't have as much money to throw at these multiple offers. And instead of getting like 25 offers on a property, you might be getting 3 to 5 multiple offers on a property. So it's not as much to draw it that far over asking price. Our month supply of inventory is now sitting at about 1.2 months worth of inventory versus where we were last year at 0.2 months worth of inventory. We were measuring inventory in days at this point last year. It was 6 days of inventory. And so it's not the extreme level that we were seeing last year. So I don't think that we're going to have the momentum in order to carry up and over beyond where we were in 2022 at the beginning part of the year.
In the beginning part of the year. But that's the clarification. Depending on where rates go, we could see, well, we're just like squeak up. Like, what is that? 2%, 3%? And remember, 2019 was 2.5. So that's where we're talking.
When you say negative appreciation through around June, is that compared to the corresponding month from 2022? Yes, it is. And since last year's appreciation was so high, could we still be appreciating just slower than the same month last year? Yes, I still think that we're going to see those cyclical monthly price gains as we go through the first 6 months of the year, but we dropped off so much from our high point last year to where we are kicking off beginning this year that it's year-over-year appreciation is going to be negative, but we'll still see monthly price gains.
And a really good thing to zero in on is the home price index. So the HPI. Fred is a website that has all of those numbers kind of in a graphical formation or a graphical form. So you can actually look at the HPI and the home price index will keep going up, right? So it's just going to go up a whole lot slower.
Yes. Expired withdrawn, are you seeing these numbers stay flat or have they increased in the past few months, 500 to $1 million, specifically financing higher? Yes. So usually what I see is over the holiday months, so going from November to December, we see a large purge of expired and withdrawn transactions. People prepare for the holidays and choose to pull their property from the market and relist in the spring months again. So expired and withdrawn transactions were definitely up, and they were up significantly on December 31st of 2022. I did see more expired listings as we got into the end of December. I'm curious why predictions are still for flat annual appreciation if the MSI is already so close to multiple offer territory in mid-January. Again, it's just because we ended up running up so high last year that we're not going to have those same price gains that we saw in the previous year. And so when we average out all of 2022, we ended up with an 11.7% appreciation. But when we look at December of 2021 to December of 2022, we were flat. And so when we take out all of those averages for the entire year, we're looking at flat appreciation. And so we could go up from December of 2022 to December of 2023. But when we average out the entire year, that's where we're going to see that negative appreciation coming back in.
And let's think about this too. If people who are listing their homes are taking the market into consideration and they're listing their homes for slightly under, right, based on some of these price reductions, if you're going in and then you're getting multiple bids just to simply land you at list or barely over, you have to think that that's already accounted for. Just because you have multiple bids doesn't mean we're seeing price appreciation. It simply means that we're having active demand and sellers are getting what they're asking for. But if they took the market into consideration, that could be flat appreciation.
Where it says new listings, that referring to new listings for that specific week, correct? Yes, that is what I'm referring to. And is that included in the average daily active count? So it is included in that average daily active count for those new listings that have made their way to market. So the average daily active count is if I were to take a buyer out and show them every property on the market today, how many homes could I show them? Right. So that includes all of those new listings as well. Can you explain what the percent of balance is measuring in detail? Thank you. So yes, so I can go through, and what I look at is if I were to create that magical 6-month supply of inventory where we'd shift from a seller's market into a buyer's market, how much inventory would we require to offset demand? And that percentage is a reflection of how much would we need to create that 6-month supply of inventory versus what we actually have now. And so that percent of balance was something that we started measuring back in COVID because we were so concerned about going into a buyer's market instantly that I was trying to stave off any of those concerns. And I just continued to measure how shallow our our inventory is right now. For better to list now or wait until after Super Bowl, price point 550 to 600. I would say right after Super Bowl weekend for all price ranges is really going to be your best time frame in which to list in.
So you're not taking any vacations anywhere near the Super Bowl weekend?
No, I've got one planned for April, but I will be in town and working over Super Bowl weekend for sure.
That's hilarious. All right, so
Did you share your
let's,
screen?
I did not yet. I don't do it quite as smoothly. After all these years, you'd think I'd get a little savvy. It just doesn't work that way. It's all right. All right. So let's jump into then, and please keep asking the questions. We'll have time at the end. Make sure that we're really kind of getting into this year, as we discussed kind of at the very beginning, is yes about the data, but taking that data and creating the story, right? Creating the relationship so that you have engagement from those buyers and sellers, so they don't get frustrated, they check out, they just turn back to renting. You've got a lot of active first-time home buyers right now. So how do you stay engaged with them? And it's around storytelling, storytelling, branding, all the fun things. So let's see what we can create together this year. So let's talk about the good news. So that doesn't look like good news. That actually looks like a mess. So it really is good news. So the New York Empire State Factory numbers came out, which is a manufacturing number. And we all kind of know this. We can feel it, that we're not buying all the things. I mean, I still have Amazon deliver, not daily. It was daily. It was a little painful, but so they're still delivering. They're just not delivering as much. Maybe they're not delivering as many big things. So we're scaling back our purchases of larger goods. You're absolutely seeing this in the auto industry. Those sales have plummeted where you were paying $10,000 over list. Now you're paying $10,000 under. So that's the kind of thing that we're seeing, the shift from manufacturing. And then last week, I talked about the fact that services had actually gone negative for the first time in years. So yes, we've moved from goods to services, but then even services, we're starting to restrict what we're spending. And I'm going to talk a little bit about this, but this is good news. It's good news for us in the real estate industry because we've already been in the recession. We're waiting for the rest of the economy to catch up with us so that the inflation drops and interest rates drop, the demand comes back, feels confident with affordability levels coming back. All of that is a storyline that, yes, it's affecting the psyche of our buyers and sellers, but for us in the real estate market, and honestly, for those who own homes, they're still in a very secure financial position. So our market really isn't drying up once we go into recession. This recession isn't that. This recession is just clamping down on some of the excess liquidity. So it's a mindset. I mean, I keep coming back to that this year is taking that data and creating the storyline for the mindset. So this just set up the stage for 2 days of data where we started to see in the 10-year yield went below 3.4, which was massive news because it dropped below one of those price point or one of those levels that it couldn't break through. So first we get this, we get the New York Empire numbers came out and it had broken a 28-month streak, which then fed into the PPI, the Producers Price Index. And as you can see, manufacturers is part of it. So are suppliers, distributors, all of those. So this is really kind of that wholesalers number. And so the PPI came out and it was -5% down for the month. This was massive because we actually dropped to 6.25 year over year from 7.3. Now, just months before, it was up at 11.7. So it dropped by almost half. And it was not that long ago. So this is going into the price of those goods long before they get to the CPI, the Consumer Price Index. Those prices of goods are coming down. Now, it's not all going to happen in a straight line and it's not all going to be a party, but it is happening. And it's very clear that once you start stripping out food and gas, that those numbers are coming down in a very solid way, in a regular way that we can count on. So we also saw the other news that came out literally like in a row, immediately got the phone out, did the TikTok, talking about the fact that retail sales dropped. Again, it had dropped 1.1 in 1 month alone. So it kind of looks, so this is the retail sales is the orange, and you're like, okay, well, that doesn't look like that big of a number. But when you're talking about billions of dollars, it does impact and it does come down. So as spending is starting to come down, remember, we're tapping out our savings. Our savings was flush with cash. We're starting to tap out our savings. The saving rate is at a historic low, and we're maxing out our credit cards. And I showed those charts last week where our credit card balances were at the max, the savings balance or savings rate was at the bottom. So we're starting to slow down our spending. We're still spending. Consumer spending is actually up. Retail sales is down. And remember, goods is a big portion of retail sales. You don't buy a lot of services inside retail sales, but services is starting to slow down too. So all of this is starting to affect the consumer. That consumer is 70% of the GDP. The GDP slows down, inflation slows down, rates come down. That's the trajectory of things I want to see. Right. So as you're talking to your clients, as you're thinking about your business model and your revenue and your volume this year. So it gave us a little bit of a pop. So that number came down, it broke through the 3.4 level and it dropped to 3.37. It started out this morning also below 3.4. Doesn't mean it's going to stay there, could bounce around still some more, but it's a good sign of things to come. As that drops, we will see our interest rates continue to drop. But again, we're not there yet. We're continuing to see a lot of volatility in our raw goods, especially in our farming goods. Of course, the war in Ukraine is still having a big impact on this. So commodity prices are not quite there yet. We're having some months where they're good, other months, well, we know what happened with eggs. So, and that didn't even have anything to do with anything other than the fact that it's something that we can't control. Those commodity prices are still very volatile, and it'll keep inflation kind of in that spin where it's not going to be straight down. We also have China opening up finally without restrictions. So they'll continue to become a bigger player, which will create more demand, which will create a bigger push on prices. So all of that has yet to play out. So we're not all the way out of the woods yet, but it is coming. And then we have a tight labor market. That number came out this morning and dropped again. So those, even with all the layoffs, people are going right back to work, and we're hearing about more and more layoffs, right? So everybody's saying, oh, here it finally is. We're going to see the unemployment number rise. We're going to see the initial jobless claims start to tick up, and they're just continue to fight it. The labor market is still so tight. And I know Patty talked about this on Friday about how we have an excess here in Colorado, 100,000 jobs without workers. So we continue to have it. The United States continues to have it, where we need more workers to fill those roles. We have, I think, 1.7 jobs for every worker. And as long as that's the case, yes, they'll be laid off and some of those companies will right size, but they'll go right back to work again. Mortgage purchase applications, though, were good, and we felt it. We felt that activity level. It jumped a quarter in 1 week. Now, remember, that whole magic of fractions or percentages when you're dealing with small numbers looks really big. So it came off of a bottom, but it recovered quite well. So that number will continue to watch mortgage purchase applications. A lot of them, when we're talking to them, the last 2 weekends were packed busy talking to first-time homebuyers, talking about what they can access, what the affordability over the last couple of years have done to them, and what they can go in at, especially given the FHFA changes we talked about, the lower interest rates for those first-time homebuyers, the programs available, the down payment assistance, the FHA loans, especially if you can find a HUD home, the $100 down, all of these programs we're talking about on a regular basis and how to help that buyer. And a lot of these first-time homebuyers too are, if they're kicking themselves a little, they're wanting to make up for it. I had a great conversation with a first-time home buyer towards the end of yesterday, and he was like, not only do I want to buy a home, I feel like I've been sitting on the sidelines, I want to start working towards a second one. Nice. And he hadn't even bought one.
That's great.
Right? It's the conversation of how do I start structuring real estate into my portfolio and my retirement plan.
That's fantastic.
I love those conversations. So all of the great things that we can be talking about right now to really engage those first-time home buyers, and maybe even shift some of the things that they're seeing. Can they rehab it? Can we do a renovation loan? Maybe it's not a perfect home. Maybe it's too small, but maybe it's a great home for a year and they can get in, especially for some of those homes that have been sitting through the holidays or are still on the market. You've got an opportunity right now before the interest rates drop and more of that demand comes back in. So builder confidence also came out, and it peaked up a little. It went from here to there, which is very small and just a couple of points. But it came out because they love lower interest rates. They have a lot of homes. In fact, they have a historically high, if I add together multi-units and single families, they have a historically high number of units still under construction because of all the supply chain issues and the labor shortages. So for them to see a little downtick in the interest rates is good news so that they can move that inventory. Now, remember, they're 11% of our inventory. They're not going to really make any waves when these homes under construction finally make it into market. And as you can see, a big portion of them are the multi-units. And I'm already hearing stories about some apartments giving free rent and having vacancies. And I think we're going to see that a little bit more, where that might not necessarily solve a problem, but just give a renter additional choices. But certainly we want to focus on those for single family homes, which did dip down a little bit as they were able to put those single family homes on the market, get them sold and get them off their books. We also saw that housing starts peaked back up just slightly for single family. That is additionally good news. Multi-units came down, as you would expect, as they're seeing some of these vacancies in the market. But both of these, I kind of drew the line. The multi-units is still really higher than they are historically, and the single families are still lower than where they were historically. We had this massive drop off during COVID. We finally started picking up a trend where we had more housing starts for single family, and then we dropped off again as the interest rates rose to 7.25. So we're bouncing still in a very low position. This really talks a couple of different stories, but the one story is yes, I'd love to see any increase in housing starts. It's not going to solve the problem of the inventory that I think we're going to have as household formation starts to go back up again, as interest rates go down. We have all those birth rates. Those 32-year-olds are still at 33 now looking to purchase homes. So it's not going to solve the problem. It's still going to keep our prices stable, right? Not allowing our prices to drop because we're oversupplied. MBA mortgage forecast. We've got all kinds of forecasts. NAR put out their forecast. Fannie, Freddie, I know you've got yours coming out.
Mine will come out February 10th.
Yes. So everybody, February 10th.
February 10th.
You want to do a little pre-announcement on February 2nd? I know where you'll be.
Yes. Yeah, I've got to wait until the 4th of the month to get the data though. So it'll be after that. So it'll be probably the weekly data, and I'll have the projections that I'll still throw in there.
Yeah.
And we'll kind of see. I'm still messing with the appreciation one. I'm just kind of stuck on what to do with that one.
Where to land it.
Where to land it.
I get that. Well, we'll definitely have some secrets that we'll share on February 2nd for sure. And remember, that is a Thursday market update that we won't have live. You'll have to come to the next big thing to find out what's happening.
Yes.
Plus all the other things. So MBA came out, and one of the things that I really kind of hitched on is that they're seeing that the average interest rate in 2023 is 5.2. So that's really good and kind of in line where a lot of other experts are starting to see it in that 5% to 5.5, definitely hitting those lower fives. But again, don't wait for the interest rates to drop. It's going to bring more demand. Now, as a seller, you might see more listings come online when we see that lower price point, because now all of a sudden I can afford more and it makes more sense. And now it's more in line with the interest rate I have and all of those conversations, right? But we're dropping from 6.6 to 5.2, and then we're going to drop a little bit more. They have 4.4. That's a little bit lower than where I was thinking. I'd love to see it. I'm not gonna ignore it because I really want to see it.
Well, and for all those people that are doing 3-2-1 buy downs, 2-1 buy
That
downs,
could really
that works out so well.
Yeah.
This is why we've been telling you about those programs, is because
Yes.
we expect or forecast are that those interest rates are going to come down. So don't let the higher interest rates be a barrier for entry for you right now.
And watch it, and we'll keep talking. Again, it's so hard to catch the bottom, as we were talking about. Now might be the bottom for the opportunities to get the discounts. When you see the bottom in interest rates, I will say there will be some lenders that would love to chase you all the way to the bottom, refinancing you 2, 3, or 4 times. It happens all the time. And they're calling you and they're going to buy the list and they're going to try and refinance you. Pay attention to what we're talking about on a weekly basis as to where the interest rates are headed and where we might start heading towards that bottom. Again, can't catch it, but can you get close enough so that it makes sense so that you refinance once, maybe twice, but certainly not chase it all the way to the bottom. I don't want to see that for any of our clients, which is why we want to bring this information to market as quickly as it's happening. And the volume numbers are still looking good. Yes, down 2023 from 2022, but starting to come right back up again in 24 and 25 when I look at these volume numbers, both in units and in thousands. And these numbers really speak to the fact that we have these strong birth rates, we have this population, we have this household formation that's not going to go away just because we're adjusting right now. So here's the May 10th. So this is what we were talking about. So Barry Habib has come out and he's done it on a number of different avenues. He's had some broker meetings. He's had some, I know some lenders have had him come in and talk over Zoom. So this has been circling around. Other people are talking about it because it's all kind of really coming from Barry Habib. So here's what this is a big mess of stuff. And you don't, and I had to kind of think through this a couple of times. But he's talking about the arrows. So the green arrows down here, these 4 arrows and these 4 arrows right there. He's talking about, I feel good about the comparison from a year ago. And we talk about that all the time, right? We talk about running these numbers compared to year over year. That is exactly why May 10th, because it's a year over year comparison of the CPI numbers. So the consumer price index, and specifically the housing numbers within it, because the housing numbers are 39% of core. So almost 40% of these numbers, of the core numbers, are housing. If that's the case, then really we need to watch housing and the CPI numbers. So if you're looking at it, if I'm over here, so this is where our current state is, but I'm comparing it to back here, well, then the overall core CPI is high. So if I have a year-over-year comparison against a high number and it comes in a little lower, it's going to look even better, right? So this is high, yet housing is really low on this same report. So housing's 40%. So we're not really going to get the nice lift that we would have hoped for a comparison of a high number. Now it's starting to drop. This is still good. This is good too, but is it going to give me all the juice? Now the CPI is super low when I'm looking at a year over year comparison. So again, I'm not going to look as good now today comparing it to a really low number. Even if I come in low today, when I compare a low number to a low number, it looks relatively flat, right? Not lower. So now when we get to May 10th, we have high core CPI and high rent. So when he's looking at the shelter costs and the core CPI costs, those two together is where he's thinking we're going to see a drop in CPI numbers, core CPI numbers. Remember, interest rates follow inflation, not the Fed rate. In fact, there's a big debate on the market right now, and you see it in the bond market, where the investors do not believe the Fed. The Fed keeps raising their Fed rate, and the rest of the market is going, we're not buying it. We're not buying that you're going to go that high, and we're not buying that you're going to hold it that long. So we're trading at a different level than the Fed rate. We're trading in line with inflation. So this is why if we see better reports coming out, and then we see a really nice drop, it could give interest rates a really good lift, or I should say drop, right? Interest rates will go down, which is exactly what we want to see. That's why the May 10th is so important. So hopefully that helped. And we know, especially as we head into a recession, and a lot of people are talking about the recession happening in the second quarter, which May is right in alignment with that. When we see recessions, we see interest rates drops, which gives us home price appreciation. In fact, Channel 7 just ran this story and had this graph on there.
Yeah,
we were talking about this week.
Yeah, I got sent that this week.
Right. And so they were showing how in most recessions, home prices increase. And remember, this one was a housing bubble due to poor credit. So you almost have to discount this one. So most of the time, a very small one. I layered over our market trends numbers to that. I don't have data that goes back to 1980 or 1981. But every time we are stronger, even in the drops, we're less. So when looking at that, you can expect that we're going to have, if not this year, because of what's happening the first quarter, certainly next year in 2024, we're going to have that pickup again of our home price appreciation. So I'm really looking forward to that. And backing that is the strength of the housing market. So just 3 quick points on it continued. Last week, I showed the delinquency numbers and how low they were and how strong our equity position was. Now we're talking about the fact that our household mortgage debt as a product of the GDP, I mean, it was outrageously high going into the bust of 2008. So now we're in a much more healthy now. We're not like where we were in 1955 when you could get a house for $20,000. That was another story. But we are back into a healthy range. We're also seeing the mortgage credit scores. We're seeing the majority of all of the originations happening right now for people with credit scores 660 and above. If I go back to 2005, 2006, you had a much more healthy number of borrowers who had under 660 feeding into the market. In addition to all the stated assets and stated income loans, you also had very unqualified buyers. You just simply don't have that these days. It's very hard for them to get a loan. And then it goes into the mortgage credit availability index, which is tracked every single week. And this continues to stay low, talking about the fact that you have to be well qualified to purchase a home. Now, of course, we have bank statement loans, we have bridge loan that doesn't have a DTI, we have access points, but they all require either assets to back up the purchase, they require a strong credit score, they require a strong job history. There's something in that there's compensating factors, right? To allow for the variations of the loan products. It's not just like breathing and you'll get a loan. So that is a continued strength in addition to all the equity we have. And then I wanted to share a story. So we were able to help some borrowers. One of the bridge loan programs that we have, not only bridges if you have a home to sell and you're buying a home, or if you're waiting for your tax returns to get done, but this one I love because we have so many seniors who are in their homes that have kind of planted their roots and they think that they want to stay there. But if they're in a home that's not appropriate for their age, or their kids with their new grandkids have moved out of the area, they might be looking at, how can I afford, because now I'm in a fixed income, I'm no longer working, I don't have a W-2 job, I can't qualify for a loan anymore, and all my equity is in my home. The majority of my assets are in my home. Well, our bridge product will also allow them to purchase a home, cross-collateralize on the home that they have that is full of equity, not worry about their debt to income ratio because we're basing it on the equity that they have. So now we have a cross-collateralization on both homes, the new one and the old one, allows them to move in, allows them to fix that home, which we know it probably hasn't been touched. It probably still has the pink bath tile and the green car. I'm not judging. I'm just saying maybe it needs some updates. Gives them some time to do the updates, put it on the market, get top dollar, then turn around and take some of that equity, take half of the equity, put it in their bank account, and take the other half of their equity and do a reverse mortgage for purchase and never have a mortgage payment again. You could look like the champion bringing a product like this to your clients who you know desperately want to be closer to their grandkids, want to be in a more age-appropriate home, but don't see that they have a path to get there. This is their path to get there. So with that, we're going to stop a couple minutes early, see if we have any questions. Gosh, what a great time to be talking about what's happening.
Why are you suggesting waiting until after the Super Bowl to list?
Question.
And that's when the market really pops up. Our inventory is historically low, but our buyer demand starts to pick up as they stop watching football right after the Super Bowl weekend. And so we end up seeing an uptick of showings between 30 to 40% over the last weekend played in the Super Bowl. And so again, that's typically when our market pops, where our market compresses the most, where we have the lowest levels of inventory and our buyer demand starts to try and find that property. What's the best way to find HUD homes?
So there are search tools and websites where you can actually, HUD has a website where you can go in and find homes that qualify for their $100 down program. I know that they have their Good Neighbor Next Door is also specifically for those who serve, whether it's police officers or teachers. But it's the HUD foreclosure. So it's those FHA loans that maybe got a little over their head. And either need to move, they don't have the equity to do so, or maybe they are in a position where they bought an entry-level home and now had a job change.
Yep. So Nicole, who on your team is best to contact for more info on reverse mortgage?
So we have Gabe Bodner on our team. We'll make sure to put his contact information on the email that we send out this afternoon, but absolutely feel free to email me or reach out. I'll give you Gabe's contact information.
And so the weekend following Super Bowl is President's Day weekend. Do you suggest waiting an additional week to list? And so unfortunately, I don't see a big change or an impact in the real estate market when we see President's Day weekend or Martin Luther King weekend. We actually see an uptick in transactions going through those weekends because they have an extra day to take off during that time.
not
Now,
really
if
a
it were-
holiday, a
if-
family-centric holiday.
Right, where
Yeah.
not everyone's taking that day off. That's a bank holiday. I'd like to share some of these slides on my videos. What guidelines or requirements do you have? Share away. Take
Yes.
it and share anything that you want. We
Yeah.
love the sourcing and the crediting. So if you can just throw out our names, we would love to have that information out there. Tag us in your posts if you're putting them on social media. We'd love to see that. What's the percentage of homeowners locked into a sub 4% interest rate and not likely to move in the near future?
It is, oh gosh. So I have a chart that I can throw up on social. So we'll put it up on the Agent Ignite Facebook group this afternoon that actually shows the breakdown. And off the top of my head, it's like 87% of homes are locked under 5%. But it has the breakdown of homes locked under 4, 5, and 6.
Are there any restrictions for refis? Do buyers have to wait in order to refi?
They do, if they're wanting to pull out any equity. So there's a new 12-month waiting period that Freddie Mac just put in place. We're waiting to hear Fannie Mae, which it really is. I'm more concerned about the delayed financing restrictions that might imply when somebody has to buy with cash and wants to pull that cash out. But the rate and term refinances don't have a restriction.
Is there a link to today's webinar that I can share with my client? Yes, I will be sending that out. I've got a meeting at 12 o'clock today.
Nice.
So I'll probably be sending that out around 1:30 today, and I'll have a summary of this week's activity, a link to register for future webinars, and a copy of this recording that will be at the bottom of my email when I send that out around 1:30 today. And then we just got to thank you. And I think we're all set. So thank you so much.
Yes.
Thank you for all of your kind words. We certainly appreciate it. Oh, one more question just popped in. Do you have a qualification sheet available to see the requirements someone would need to meet in order to do that reverse mortgage?
We sure do. We can put that up on our Agent and I Facebook group as well. And then Gabe can also share that information if you reach out to Gabe Bodner.
Awesome.
Yeah.
One more question pop in there. Thank you so much. I love this data. You're welcome.
We do
It's
too.
our pleasure. We love to do this stuff. And so that's why we bring it to you every week, and we'll be back at it next Thursday at 10 o'clock. So make sure that you're registered. Do you know how many people we had on this webinar today?
How many?
We had 1,500 plus. And so we have the great capture rate right now of people that are consuming this information. I'm distributing it to about 6,300 people on a weekly basis. So hopefully this becomes your go-to report when you're trying to better advise your buyers and sellers, and that you use Nicole and me as a resource when it comes to your future transactions. There's been a lot of confusion lately about what I do for a living. I'm a title rep. My job is to help drive title business to First American Title. And without you driving that business to First American Title, I don't have income. And so what I'd really love to see is that if you have an upcoming listing that you'd like to work with First American Title on, that you reach out to me, or if you have an upcoming borrower that's coming to market to start their hunt for a search, reach out to Nicole Ruth and her team with One Trust Mortgage. And so please reach out to us if there's anything that we can do to help you out. We'd love to handle your transactions. And thank you so much for tuning in, and we will see you soon.
We will. Bye-bye.
Bye.